Hello and welcome. See, we have a couple of people have joined in here. I do want to make sure that my audio is working. So, if you're here early and you wouldn't mind helping me with the audio check, I appreciate that very much. Just simply type something in the chat. Let me know that we're all set, that you can hear me just fine. We got an audio check. I see you on YouTube. I don't know how to say your username, TBDBITL 7881. Can you hear me okay? How's my audio doing? Appreciate that. Thank you very much. Audio's working well on YouTube, it sounds like. Okay. How we doing on Facebook? I see we have some on Facebook. If you're willing and able to chime in, just let me know how my audio is. I want to make sure that we don't have any issues, that you can hear me just fine. We're going to get started here right at the top of the hour. So get settled in. If you haven't already got a beverage of choice, something that you can enjoy while the workshop's going, pad of paper, pencil, pen, whatever your choice is there. We'll get started here right at the top of the hour, about 8 minutes to go. About 6 minutes till we'll get started. So, if you have any beverages you'd like to get, writing utensils, anything at all that you'd like to have during our workshop time, I encourage you to take care of that now. Run to the restroom, all that good stuff. So, we'll get started here right at the top of the hour. We got about 6 minutes. We're going to get started here in about 4 minutes. Get settled in. If you have anything that you are looking to use to write, take some notes, that'd be fine. Just go ahead and get that stuff together. We're going to be starting the presentation here right at the top of the hour, 3 minutes to go. You do want to go get your beverage of choice if that's something that you'll enjoy. Quick run, take care of the restroom, all that good stuff. We'll get started here again. About 3 minutes now. Start right at the top of the hour. Have about 2 minutes till we get started, so do take care of any items that you have, but we'll get started here in about 2 minutes. Got about a minute till it's time to get started. So get settled in. We'll get started here right on time. So we'll be cruising here in just a minute. Okay, welcome everyone to a Financial Resource Academy presentation of our Social Security workshop. Retire Right, Unravel the Social Security Mystery in 1 hour. So we'll do our best. Excuse me. We'll do our best to do that in our hour time that we have together. Hi, Patty from Facebook. I see you there. So we're going to cover the topic of Social Security. In fact, why don't I just give us an agenda? We're going to cover in about an hour the topic of Social Security. I will do my best in that hour time that we have together to cover as many things as I can that I know will be as meaningful to the majority of you that we can pull off in that hour time together. So that's our goal is to really just get as much information that will be as meaningful to the majority that we can. Now we will at the end of our hour time together, we will have a Q&A portion of our discussion. So that will be right at the end of the presentation. We'll do a question and answer portion. And we'll also talk about how you can get access to our Social Security filing workbook. So I do know that many of you are hoping to get that Social Security filing workbook. We do want to make it available to you. And so you'll have the ability to request that. And we'll talk about how you can request it right at the end of the presentation. My name's Kyle McCauley. I'm the Chief Investment Officer of Entrust Investment Services. I'm a chartered retirement planning counselor, an accredited portfolio management advisor, a National Social Security Advisor certified professional, and I also happen to be the author of the workbook, so I do hope you enjoy it. Now, the reason why I share with you a little bit about my background is really just so you have a good understanding of what my thoughts are or what my focus is when I do this presentation. So when I do this presentation, I'm often thinking about other folks very similar to you who have had to make this retirement planning decision of Social Security, when to file, what's the right strategy, and really how does that dovetail with your other retirement planning needs. Our firm also specializes in retirement income strategies, and so when I'm doing this presentation, I'm also thinking about, well, how do we coordinate these things together? So that's kind of my focus. That's my thought process when I'm actually doing this presentation. And what I am not is I'm not affiliated with, nor am I employed by the Social Security Administration. Purpose of our discussion today is for me to lend you my experience and expertise in this world of Social Security planning. I am not here to sign you up for benefits. Okay, that's the job of the Social Security Administration. I am able to provide this advice to you because of our firm, Entrust Investment Services. We are a registered investment advisory firm, and so we are able to provide this advice to you. Now, why is Social Security such a hot topic? Why is it that whenever I do these presentations, we get people showing up, registering? Every time I am ready to do a presentation, there's people who are ready to attend. Why is that? Well, there's just simply a lot of folks who are turning the ages that are qualifying for benefits like Social Security, Medicare, And there are 10,000 baby boomers on average turning 65 every day. That turns into 3.64 million per year. And that's been going on for the last 12 years and is expected to continue still for another 6 years. So a lot of folks who have uh, claimed benefits already in many cases, but also still to come, many more folks who are going to claim. So it brings up concerns. Hey, will there be a benefit for me? What about insolvency? Those sorts of concerns certainly come to the forefront. So we'll definitely touch and talk on that. So, what does Social Security mean to you? 65% of middle income Americans derive more than half of their retirement income from their Social Security benefits. Now, that's obviously going to be true for those who maybe haven't done a great job of saving other forms of retirement income, but it's also going to be true for those who have. So, even if you've maybe accumulated a pension benefit or put dollars away in a 401k plan or IRA accounts or other types of savings vehicles, the reality is that even if you've done a great job with that, your Social Security benefits, they're still here. I'm sure if we were in a room together and I asked for a show of hands, hey, who's heard don't count on Social Security? I'm certain that many of you, if not all of you, would raise your hand. I've done this live enough to know that. Now, also, I know that not only are the benefits here, but in many cases they can be quite good. So it is not uncommon for us to see a married couple with 50, 60, 70,000, sometimes even $80,000 or more per year in Social Security benefits once they've gone ahead and filed for those benefits and turned them on. So the benefits are here, and in many cases, they can be quite good. Now, Social Security has been enhanced in its importance for today's retiree, in large part because pensions have really gone away in many cases. Now, I still see a lot of folks who have pension benefits, but they're not what they originally thought they were going to get in many cases. The pension was frozen, it was locked. They converted people over to 401k plans. Unfortunately, we've seen pension benefits that have been reduced even after people started taking them. So, really, pensions have experienced a big upheaval going back to 1985 and following. So, that has enhanced the value and the importance of these Social Security dollars. In addition, 46% of Americans today currently pass away with less than $10,000 to their name. Now, this statistic is not here to frighten you. What this statistic is here to highlight is one of the key important features of your Social Security benefits. So, if I were to ask you, do you insure all the important financial things in your life? Chances are you would say yes. Do you insure your home? Yeah, definitely. How about your car? You bet. Do you insure your health? Absolutely. How about your retirement? Do you insure your retirement? The answer is actually yes. Social Security, if you frame it in, if you think about, okay, what do these benefits mean to me? If you frame in what Social Security means to you, Social Security is best framed in as retirement income insurance, or you could say longevity insurance. Again, even if you're that person who passes away with less than $10,000 to their name, the reality is that you are still receiving a Social Security benefit even if, the rest of your savings may be gone. So as long as you qualify for a benefit, those benefits are going to continue to pay to you so long as you are still living. So, Social Security would be a form of retirement income insurance. Now, that could be pretty important these days. National Library of Medicine in 2020 did a study. This is even with COVID in mind, so just bear that in mind. That life expectancy continues to climb. People over the age of 65 are living longer and longer. Used to be 97, it's now 99 for a married couple, female. Age 65, ladies, you have a life expectancy of 99. Gentlemen, this used to be 92. It's now 97. So folks are living much longer than they ever expected to. My granddaddy is a great example of this. He's on the old statistics. He passed at the age of 92, but he had 4 heart attacks and 3 bypass surgeries before the age of 75. So if you'd have asked him at say 77, "Hey, granddaddy, you think you'll make it to 90?" He would have smiled and shook his head and said, "I don't think so." But my granny is a large reason for this. He did well. He lived a good long life. Now, I don't know if you can live as long as this lady, Maria Brañas. Currently, she's the oldest living person. She was born in San Francisco. She currently lives in Spain, and she's 116 years of age. So, Maria is currently the oldest living person, although I didn't check before the workshop. So, unfortunately, sometimes I have been known to do this workshop, and our oldest living person has switched over. So, I didn't verify just before the workshop. So keep that in mind. But yeah, 116 years of age. So, how long could you live? Who knows? I heard on a podcast the other day someone saying that they're convinced that we'll see people living to 150 within the decade. So I don't know if that's no, that doesn't seem possible. If the oldest living people are in 100 teens, it would take 30 years. Well, that person clearly didn't know what they were talking about. But in any case, let's keep going. All right. What are we going to focus on for today? We're going to focus on some basics about how your benefits work, how they're calculated. We'll talk about strategies for those of you who are married. We'll talk about options for those of you who are divorced, options for those of you who are widowed. And then if you fall asleep somewhere in the middle, please do wake up in time for taxes. Also, for my single folks, do not miss out on the discussion around taxes. I can tell you, having now run hundreds of analyses for folks, that if there is one single item that takes a couple of strategies that they kind of all look similar and says nope, these aren't going to work, we have to file like this, it is the issue of taxes. Taxes is a very important function of our decision making process about when is the best time to file for Social Security. So we'll make sure that you have a good understanding of that. Let's talk about some basics of the benefit. So in order to qualify for a Social Security benefit, you need to have 40 credits. Technically, it's 40 credits, not what you may have heard, which is 10 years of work. Although the math typically works out the same, so it's probably close enough to say 10 years of work, but technically it's actually 40 credits. You can earn 4 credits per year by having substantial earnings during a calendar quarter. So that's $1,640 of earnings in a calendar quarter will get you at least 1 credit. 4 credits per year times 10 years gives you your 40 credits. So generally, if you have 10 years of work, you have a Social Security benefit. Now, not guaranteed, so just check if you're on the border, but do understand that most of the time it will be fine. All right. Now, how is your benefit actually calculated? Your benefit is calculated by taking the highest 35 years of indexed earnings, meaning what will happen is you'll take your 35 years, highest 35 years of earnings, regardless of when they occurred. So you could have worked 20 years, taken 10 years off, worked another 15, no problem. You still have all 35 years. So it's the highest 35 years, no matter when those years occurred. Secondarily, once you have once you're filing for a benefit, yep, your benefit is calculated based on not dollar for dollar what those earnings were, but after those dollars have been indexed for inflation. So in the Social Security workbook that we're going to be sending to you, and again, I'll talk about how you can request that at the end of our presentation today. When we send you that workbook, one of the things you will find in there is an earnings table or an indexing table. That indexing table, you would put all of your earnings that are on your Social Security statement, and you could see what those dollars are worth when they're converted in today's dollars, accounting for inflation. An example of this would be if you earned $20,000, say in the year 1980, that would be worth almost 5 times that value. So it'd be worth over $90,000 in terms of your benefit calculation. Why is that important? Well, some people do mistakenly assume that if they file for benefits, they are automatically going to be, or excuse me, if they keep working, they're automatically going to be increasing their benefit. Not necessarily. In order to increase your benefit for the future, you have to be replacing a lower income year in the past. So if you are working and say earning $50,000 today, maybe you've gone part time, or you're just not earning as much as you used to. The point is that that 50,000, if your lowest income year in the past is 20,000 in 1980, well, remember, you do the inflation calculation, that 20,000 in 1980 is actually worth less. Okay, so that 20,000 in 1980, or excuse me, the 20,000 in 1980 is worth more. So 50,000 is worth less. So that 20,000 in 1980 is worth a little over $90,000 in today's dollars. And so you're not replacing that with your $50,000 of income now. Now, working now is not likely to decrease your benefit. It just may not increase it further. Okay. Now, what happens in the scenario where you don't have all 35 years? Let's say you only have 25 years. Well, in that scenario, the way Social Security is calculated is you'll take those 25 years of earnings that you have, and then Social Security is going to add 10 zeros into your benefit calculation. So, any additional work that you're doing today would be replacing a zero and should have a pretty good size impact in terms of increasing your benefit for the future. Now, there are two primary provisions that can decrease your Social Security benefit. The first one is called the government pension offset. This happens whenever you have a non covered pension. This is a pension that you would have earned while you were not paying taxes into the Social Security system. Okay. So you're not paying taxes in the Social Security system. You're earning this pension typically from a government agency or a state government. And so you earn the pension. You're not paying taxes in the Social Security. So that pension is non covered. When you file for a non covered pension, and you try to then file for, say, a spousal Social Security benefit or an ex spousal Social Security benefit, what happens is you do a 2/3 calculation on your pension. So 2/3 of your pension counts against any Social Security dollars you could receive. And if that number goes negative or zero, you'll get nothing. So it is possible to receive nothing if you fall under the government pension offset. The other one is the windfall elimination provision. This one is a little more complicated with the calculations. Both the government pension offset and the windfall elimination provision calculations are in your workbook. So don't fret; they are in there, and you can investigate further on this. But the windfall elimination provision happens when you have your own Social Security benefit. You still have that non-covered pension. You go to file for the non-covered pension and Social Security, depending on how many years of substantial earnings you have, will determine how much your Social Security benefits are going to be reduced. Okay. So those are the two primary provisions that can reduce a Social Security benefit. Now, how does Social Security work? I think you know this, but if you don't, you've paid a lot of money into the Social Security system. Okay. About 6.2% of your pay has been going into this system over the last, 10, 20, 30, 40, however many years you've been working. Okay. Your employer has matched that for a total of 12.4% of your pay, again, over all the years that you've been working. I think if you were to do the math and think about it, okay, 12.4% of my pay over the last 40 years or 30 years or whatever it's been, is that a sizable amount of money? For most of you, that's probably a sizable amount of money. So important to remember that these benefits you have absolutely paid for. They are yours, and you should do what you can to maximize and get what you can out of them. Now, I'm probably preaching to the choir because you're here, but I just find it important to highlight that because sometimes we can make the mistake of saying, oh, well, I just want to make sure I get something. I understand that mentality, but at the same time, do the planning work to really maximize what you get. It's not as if these dollars are not yours. You have paid for them, and you deserve to get what you can out of this system. Now, today's dollars that are flowing into the system are flowing out right now. So I told you to imagine an account somewhere with your name on it with 12.4% of your pay in it. Well, that's not how the system works, unfortunately. Unfortunately, the way it works is that we are on a pay as we go type of a system. So when you are paying FICA taxes or Social Security taxes into this system, those dollars are leaving right now to pay current recipients. So that means we're operating in the red, and we've been operating in the red since 2010. The first year we operated in the red was 1983, and they fixed that by adding taxes to Social Security. That was President Reagan. They increased those taxes in 1993. That was President Clinton. And so I like to bring that up because we could all be upset together. But in 2010, we started operating the Social Security system again in the red, and we've been operating in the red with no pause since then. Now we're still fully funded through the year 2035. So sometime in 2034, they'll fix the system. Joking a little bit, but you get how it goes. All right, what happens in 2035? Well, we're funded roughly 80 cents on the dollar thereafter. But let me tell you what that does not mean. What it does not mean is that in 2036, all of your benefits will be cut by 20%. No, they will fix the Social Security system in an actuarial kind of method. What do I mean by that? Well, you all know this already because you saw this with your parents. Your parents had a full retirement age of 65, and the oldest of you have a full retirement age of 66. Most of you probably have a full retirement age of 66 and some number of months, and then there's probably some of you that have a full retirement age of 67. Okay, so that process of moving from 65 to 66, 66 and some number of months depending on your year of birth, all the way out until age 67, that process was a fix to the Social Security system. So most likely they'll do something like that again to your kids and grandkids. Common discussions are you can't file anything at 62. You got to wait till 64 or maybe even all the way to 65. Increasing full retirement age. Hey, we bumped up full retirement age to 67, but we think it should go to 70. Increasing taxes, as you can imagine, is not very popular, but it does get discussed. Okay, I know that many of you do have that full retirement age of 66 and some number of months, but just for ease of explanation, we're going to assume for a minute that everyone has a full retirement age of 66. If you file for your benefits at full retirement age, and you take those benefits right at your full retirement age, the percent of PIA, that's the right column, percent of PIA. PIA stands for primary insurance amount. If you file at full retirement age, you are going to receive 100% of your primary insurance amount. That amount is estimated for you right on the front of your Social Security statement. It's the big, bold number. That's your estimated primary insurance amount. If you file at full retirement age and that number says $2,000, you should expect to receive $2,000. If you file at 62, you should expect to receive only 75% of those benefits. So that means that if you file early, you do take a reduction. It can be reduced all the way down by age 62 is the earliest you can file to 75%, meaning $2,000 is now worth $1,500. If you delay past full retirement age, you can do that and you can be rewarded until you reach the age of 70. They will reward you at a rate of 8% per year, simple interest, not compound. And so if your full retirement age is 66, 8 times 4 is 32. So you would turn your benefit from $2,000 into $2,640 by delaying till 70. Now, there are actually 3 distinct benefits that you can file for The first is a retired workers benefit. That's a benefit you can file for based upon your own work history. Spousal benefits are benefits you can file for based upon a spouse's work history or an ex spouse's work history. Widow or survivor benefits are benefits that you could be entitled to based upon a deceased spouse or deceased ex spouse's work history. The last time Social Security law was changed was in October of 2015. Basically, what they did is they took away all the fun stuff. So, if you've heard of restricted applications, file and suspend, get a lump sum check. All of that is gone at this point. Now, there is a very small group of folks who are not yet 70 who were born before January 2nd of 1954 who've not yet filed for Social Security benefits, who have access to an ex spousal or spousal benefit, and they could still do a restricted application here for 4 months. But that's it. After that, all the fun stuff is gone. Now, if you are thinking, well, is there any filing tricks anymore? Are there any more strategies? Yeah, yes and no, but let's talk about what there is. Okay. So if you were born on or after January 2nd of 1954, or even if you were born before that, you can voluntarily suspend your benefits at any time for any reason. Now, why would you do that? Well, because if you suspend your benefits after reaching full retirement age, you can still earn delayed retirement credits from full retirement age until you file later, as late as age 70. So if you filed early, but then thought maybe I shouldn't have done that, you still are eligible if you suspend benefits to earn those delayed retirement credits. Now, you can also do what's called a rescinding of your application. If you rescind your application, what happens is you tell Social Security, stop paying me. I would like to receive my I would not I would like to stop receiving my Social Security benefit and reset my benefit as though I never filed. They will say no problem so long as you're within the first 365 days from when you filed and you pay back any dollars that you've received thus far. So do understand that it does make those two requirements, but you can, in one time only, reset your benefit as though you never filed. Now, let's talk about married spousal benefits. In order to qualify for a spousal benefit, you need to have been married for at least 1 year. In addition, the primary worker has to have filed. So that's how you qualify. But how much are you actually able to receive? Well, the amount you're able to receive is up to 50% of your spouse's primary insurance amount, not the amount that they're receiving. So their primary insurance amount, the amount that they were entitled to at their full retirement age, 50% of that is available to you at your full retirement age. Now, you are eligible to receive your own benefit or a spousal benefit, but not both. Okay. If your spouse has a $2,000 benefit, half of that is $1,000. If your benefit's 1,200, you're just going to receive your 1,200. The 50%, $1,000 is not going to be meaningful or available to you. Now, spouses are eligible to file for benefits early, but the schedule for filing early is reduced at a faster rate. So you'll notice here that if I have $1,000 a month benefit and I file at 62, I'm going to get $750 or 75%. But if it's not my own benefit, it's a spousal benefit. I'm not going to get $750. I'm only going to get 700. So that's on the far right column there. Also, if my own benefit is 1,000 and I delay till age 70, I can get 1,320 for the delayed retirement credits. But if it's not my own, it's a spousal benefit, there are no delayed retirement credits. If I delay till 70 on a spousal benefit, I'm not going to receive anything more than just that $1,000. Now, survivor benefits. So for my married couples, when one of you passes away, only one benefit remains, and it's always the higher of the two. So if your benefit's the higher benefit, you'll just simply keep your own. If your spouse's benefit is the higher benefit, you'll say goodbye to your own and you would switch to your spouse's if they predecease you. The benefit of the deceased can only be increased under one situation, and that is the 82.5% rule. If you file for Social Security benefits, say at 62, you're getting 75% of your primary insurance amount. If you predecease your spouse and your benefit is the survivor's benefit, they will get a bump up from 75% to 82.5%, again, because of that rule. Two most common mistakes we see married couples make. First one is that the higher wage earner actually files early and unfortunately shortchanges a surviving spouse benefit. Why would that be a mistake? Well, you have to remember that when you think about these Social Security benefits, consider them as longevity insurance. But when you're married, it's not just your longevity, it's also you and your spouse. So if one of you lives, say, to age 90 and the other of you passes at 70, you say, great, good thing I filed early. But what if filing early left your surviving spouse with a much smaller Social Security benefit? So, generally speaking, between the higher and lower wage earner, if one of you is going to file for benefits early, it's going to be the lower wage earner. And if one of you is going to do any kind of delaying at all, it's going to be that higher wage earner because your benefit is the survivor's benefit. Now, I can also tell you that it almost never works out for both of you to delay past full retirement age. Generally speaking, one of you is going to delay to some degree or another, and one of you is going to file early to some degree or another. It just rarely works out that both of you should be delaying past full retirement age. Okay, let's talk about benefits for those of you who are divorced. In order to qualify for a divorced spouse benefit, you need to have been married to your ex for at least 10 years in a row to the same person. Okay. So married 5 years, divorced, remarried even to the same person 7 years, divorced. 5 plus 7 does not equal 12. One of those two stints has to be at least 10 years. Also, you may not be currently married. So if you had a marriage that lasted more than 10 years and you're thinking, hey, maybe I'd like to file on their benefits, but you're currently married, say goodbye to those ex-spousal benefits. It's just your own benefit or your new spousal benefit that you're dealing with. Same benefit amounts in terms of no increases for delaying, as well as extra reductions for filing early, apply for the divorced spouse benefits in the same way they did for the spousal benefits. One major difference between divorced spouse benefits and spousal benefits is our last bullet point here, and that is that you're independently entitled to file for divorced spouse benefits so long as you've been divorced for at least 2 years. So with a spousal benefit, your spouse actually has to file for you to file spousal benefits. But if you're divorced and been divorced for at least 2 years, whether they filed or not is immaterial. You can file for those ex-spousal benefits regardless of their filing status. If you happen to have been born before January 2nd of 1954 and you haven't yet filed for Social Security and you have access to a divorced spouse benefit, the restricted application would earn you about 4 months of benefits. So get it filed. All right. One goofy thing about the divorced spouse benefits is that if you have a marriage that lasted more than 10 years and that person is younger than you, and let's say you hit 62 and file for your own benefit. A few years go by, they hit 62, and the ex-spousal benefit becomes available to you. Can you switch? Yes, you can if it's more. And as many 10-year marriages like as that you can fit in, you could switch again and again. It is allowed. Okay. Common questions we hear from those who are divorced. I'm divorced. I'm going to be filing off of my ex. Are they going to know that I've done that in some way? No, they won't. There's no effect to them. It's not going to cause their benefits to adjust. The only way they would know is if you told them. And if they don't attend my workshop, you could probably freak them out, but it doesn't affect them at all. All right. Divorce spouse benefits when someone else claims on me. So I'm divorced. My ex is going to file on me. Is that going to affect me? No. Remember, their filing off of you does not affect you in any way. But wait, I'm remarried and my new spouse is going to file off of me. Well, my current spouse and my ex spouse, will their benefits affect each other? No, they will not. Okay. I actually have a few 10-year marriages, and they're all going to file onto me. My new spouse is going to file on me, and I'm going to die young. Too much stress. No, okay, just kidding. But the point is that yes, they can all file off of your benefits, and yes, if you die young, they can all get widow benefits. It is allowed. Okay. Let's talk about widow benefits. Widows are a very special group when it comes to Social Security filing. The primary reason is because they can file at the age of 60. They're the only folks who can file at the age of 60, but they must remain unmarried until reaching the age of 60 in order for those widow benefits to be available. One of the very first workshops I ever did during the Q&A portion of our time, lady in the back raised her hand and said, "So if I understand you right, it sounds like I need to delay the wedding." Now, in her case, it was kind of a big deal. And the reason why it was a big deal is because if she had married in September, which was her planned wedding date, she was still 59. She had a previously deceased spouse. She was a widow. But her birthday, her 60th birthday, wasn't until March of next year. And at the time, this was a July workshop. So, yes, if she married in September, she would lose access to those widow benefits. In her case, the widow benefits at the age of 60 were just under $1,900 a month. Her own benefit, which would not be available until 2 years later at 62, because remember, you can't file your own or a spousal benefit till 62. So you have to wait 2 years. Her own benefit was very small. I don't remember what it was, but her next highest benefit was actually her new spousal benefit, and that was just under $1,400 a year. So how awesome is this? I have to wait 2 years to get $500 a month less. So yeah, we did unfortunately suggest she might put the wedding off. Now, I'm a religious person, so I think this is funny. You can decide how you feel about it. But she went to her priest and said, can we, just do the religious part of the ceremony and delay the wedding, the legal stuff, the signing? Can we do that later? And the priest said, no, no, no. I said, there's another priest. Someone will do this. But she's very devout. The wedding was delayed. All right. Oh, last provision about widow benefits. In order to qualify for a widow benefit, you do need to have been married for at least 9 months. This is only here to prevent deathbed marriages. It's not here to hurt you. So if you can provide some evidence that it wasn't a known reason why your spouse would pass, then widow benefits can be reopened. Only real life case I've run into this. I've done lots of these, and so I've only run into it once. But lady was married later in life. Husband was in the armed forces. He was shipped overseas, killed. They'd only been married about 6 months. But it wasn't as though he had a terminal illness or some known reason why he would be passing. And so we just submitted documentation, and her widow benefits were reopened. Now, John, this is a case study on widow benefits that highlights that widows do have the most options. Now, John never elected for his benefit. He died at the age of 64. If he had filed at full retirement age, his benefit would have been $2,150 a month. Jane is 5 years younger. She's 59 when John dies. She remains unmarried until the age of 60. Excuse me. But Jane does have her own work history, and so her own benefit at 62 would be worth $1,197. What are Jane's options? So option number one is that Jane could simply go and file for those widow benefits and start collecting $1,537 a month. If she does that, because she's eligible, and she collects it until she passes at age 85, she gets $461,000. No cost of living adjustments are being applied in this example. Now, what if Jane was still working and she couldn't file widow benefits because she has too much in earnings? Well, let's say she's going to work for 2 more years, and then she hits 62, and then she actually starts with her own $1,197 a month benefit, and she collects that from 62 till 67. And then at age 67, what could she do? That's her full retirement age. Widow benefits maximize at full retirement age, not 70. And if she files like that, she would bump up from 1,197 to $2,150. Total benefits over her lifetime, 538,835, more than excuse me, not 100, $77,000 more simply by understanding her options. Now she has another option. Let's say she's not working. She does go ahead and start those widow benefits at the age of 60. She collects those benefits from 60 until 70. Why does she change something at 70? Because her own benefit at the age of 70 has now grown from 62 to full retirement age. She's earned delayed retirement credits until 70. She's now eligible to receive $2,108 a month on her own benefit beginning at 70. And that is more than $100,000 more than if she had only filed for the widow benefits. So, again, very important for Jane to understand her options. She will not get a phone call from Social Security informing her that she should switch to a different benefit or do any advanced planning. They're just going to give her whatever she files for. And so Jane does have to know about her options. Okay, you are allowed to work and collect benefits simultaneously. However, if you are filing for benefits prior to reaching your full retirement age, you are limited in how much you can earn. In the year 2023, the limit is $21,240. So the first $21,240 that you earn, Social Security does not care. they say that's fine. But the minute you go above 21,240 in earnings, Social Security cares. They care about $1 for every two above the limit. So let's take an example here and say that you have a salary of $61,240. Kind of an odd number, but the math will be easy and you'll see that. Well, remember, Social Security does not care about the first 21,240. So you take that off the top. That leaves you with $40,000 above the limit. They care about $1 for every two. So what do we do with the 40,000? We cut it in half. So we have now an ineligibility of receiving $20,000 from our Social Security benefits. So how does that work? Let's say your benefit that you want to file for, you're 63, let's say, and you're filing for a $2,000 a month benefit. 2,000 goes into 20,000 10 times, meaning you will not receive a benefit in January, February, March, April, May, June, July, August, September, October. Then you'll receive a $2,000 check in November and a $2,000 check in December. Some people mistakenly assume that they could take benefits and receive a benefit all year. It'll just be a reduced amount. No. Unfortunately, the way it works is they simply will not pay you anything until you've paid back what you were ineligible to receive. So, important to remember that you can file for benefits prior to reaching full retirement age, but your earnings do matter. Now, in the year that you turn your full retirement age, but before you turn your full retirement age, this is the right-hand side of the screen, you can earn up to $56,520. The calculation is then 1 for 3. This almost never applies to anyone, so I'm not going to spend any more time on it than that. However, once you reach your full retirement age, you can earn any amount that you would like. There is no earnings test. There's still taxes, but no earnings test. Okay, let's talk about taxes. Taxes, unfortunately, is very complicated. Publication 915 from the IRS is produced every year to tell you everything that you could possibly want to know about how you'll be paying taxes on your Social Security benefits. It takes 33 pages, apparently, for them to do that. Why does it take 33 pages? I don't know. Call your Congress people. I mean, it is a little bit nuts. It's a little crazy. They're trying to means test it in a very bizarre way. 33 pages, though, is what it takes. Now, there are some useful things in this publication 915. This is a worksheet that would detail out for you the 19-step process that you must go through to determine just how much tax you're going to owe on your Social Security benefits. Now, what we are not going to do for today's discussion is go through all 19 steps. So don't worry if you're freaking out. Uh, Calm down. It's all right. We're not going to go through all 19 steps. Okay. What we are going to do is just highlight some of the key important things that you should keep in mind when you're thinking about how these taxes are going to play into your Security decision. Line one on this worksheet is a very important item. It is where you put your suddenly it just flew out of my brain. Provisional income. There we go. Provisional income. Line one is your provisional income number. Provisional income is something you never have to worry about on your tax return until you file Social Security. Okay. So they introduced this brand new calculation once you file Social Security benefits called provisional income is the starting point. Provisional income is 3 items. Number one, your modified adjusted gross income, all sources of income that you have, earned income, pension income, annuity income, IRA withdrawals, ordinary income, interest income, dividend income, capital gains, long and short, all the sources of income that you have. Okay. Rental income. I don't think I said that one. The point is that it's everything that you have counts into that number. So what? Yeah, I get it, right? I gotta pay the taxes. I'm with you. Okay. What's the next item? Municipal bond interest income. Now, for those of you who own municipal bonds, you probably did it because you didn't really want to pay taxes on all that. Understandable. So, yeah, let's maybe not pay so much in taxes on these retirement income dollars. But unfortunately, municipal bond interest does count into the calculation that will determine how much of your Social Security benefit is going to be taxable. So the IRS found a way at it. Now, the third one, I've done this live enough and had people yell out things like, that's double dipping and that. So if you feel that way, I understand, but I'm just telling you the news, okay? The benefits you're receiving from Social Security, 50% of them count in your provisional income number, which is the starting point that tells you how much tax you're going to owe on Social Security. Okay. So all sources of income, municipal bond interest income, 50% of your Social Security benefits is your provisional income number. Now, if you are single and your provisional income number is more than $25,000, you start paying taxes on your benefits. If your provisional income number and you're single goes above $34,000, you could be paying tax on up to 85% of your benefits. Married couples, provisional income of 32,000, you start paying taxes on benefits. If you have more than $44,000 of provisional income, you could be paying tax on up to 85% of your benefits. That's how much is taxable. The question, of course, is, well, how much tax do I owe? Fortunately, this is where it gets complicated. So let's say you're cruising along through retirement, everything's going pretty well. You've got maybe some pension dollars coming in or withdrawals out of your 401k plan. You filed for Social Security and everything's going pretty well, right? You're enjoying things, you're enjoying retirement, it's all good. But this year, we're coming off of all the COVID stuff. The retirement's going on. It's time to do some travel. I'd like to check off some bucket list items. I'd like to have places I'd like to go, things I'd like to do. So you're talking to a friend or a loved one or whatever the case may be, and they say, "Yeah, I'd love to go on a trip." Me too. I've been waiting for this, and so you budget things out, and you're going. You're figuring out where you're going to go, and you say, well, this is going to be a nice trip, but we're going to spend some money. We're going to spend $15,000 on this trip. Great. $15,000. You call up your 401k plan because you surveyed all your accounts and said, where am I going to get this? I got to pay for this. You booked the trip on the credit card, but it's time to pay off the card. How are you going to do that? Well, I'll take from my 401k. Why not? I mean, what did I save all this money for? I saved it for me. So you get to the 401k plan, you call them up and you say, "Hey, I'd like to pull 15,000." They say, "No problem." Then they ask you a very important question. How much tax would you like to have withheld? Oh yeah, yeah, of course, right. You knew that was coming. So you say, what's the minimum? No, don't say that. No, you say, well, let me look at a tax return. Maybe you're feeling especially prudent, and so you look at stuff. You go, okay, I'm going to withhold 12%. I'm in the 12% tax bracket. I'm going to withhold 12% on this distribution. They send you your money, you go on your trip, you've paid it off, it's great. Until next year in April, you are punching, unless you're a go getter, then maybe March or February, you're punching stuff into TurboTax, you've shipped it off to your accountant, or you're using another tool, whatever the case may be, you're punching it all in, and TurboTax keeps saying, I owe money. Wait a second, I never owe money. I always withhold. In fact, I always get a little refund. I like that. I like to get a little refund. What's going on? Maybe you call the accountant, or you hop on the phone with TurboTax and you're saying, "Hey, what's going on? I don't understand what happened here." Well, here's what happened. When you took that $15,000 distribution, you were above these limits and you were not yet paying all the taxes you could be paying on your benefits. So what happens is you pay you took the 15,000, that was taxed at 12%, but you didn't account for the fact that you had social security dollars that became taxable. And 12% here plus 12% here is 24%. So you had an effective tax rate of 24% on a distribution that really was only taxed at 12. Okay, you got to be careful about stuff like this. That's a bummer. It's not no one's favorite. No one likes to see that. But I was just doing some planning with someone earlier today, and they're headed for this one. I see this way too often where people are headed for this one because that one's not so bad. This one is the bad one. One day you wake up and you're 73, or depending on your age, you're 75. Happy birthday. It's time to take your required minimum distribution. Your required minimum distribution, you don't have a choice. You must pull from those 401k, IRA, 403b, 457, TIA, TSP, all of those types of accounts. You got a tax break for putting money in. You've paid no taxes until you pull money out, but the IRS doesn't let this go on forever. Once you hit your RMD age, or required minimum distribution age, you don't have a choice. You must pull those dollars out. When you pull those dollars out, if you've done like many folks and you've been very prudent and diligent and you've gotten things paid off and your spending's not too crazy and you've accumulated some assets, you got your matches at your 401k plan and so on, and so those accounts have grown. And you don't want to spend too much because you don't want to be a burden to your family. You want to be able to take care of yourself as you age. Perfectly natural and understandable. But now you are continue to see those accounts grow even in retirement. But then you hit required minimum distribution age. You don't have a choice anymore. You must pull. The larger the account, the larger the amount you must pull. And all of a sudden you pulled so much that, whoops, I'm not in the 12% tax bracket anymore. I went up to the 22% tax bracket. Now it's not 12 plus 12 is 24. It's 22 plus 22 is 44. These are the kinds of tax mistakes that we really want to help you avoid, okay? Because it could make a big difference. Let's look at a case study that highlights just how important taxes are and how they play into the Social Security decision that you make. These clients, 64 and 62, they have just over $34,000 in combined Social Security income if they file at age 62. They're going to start their retirement with $752,000 in 401k and IRA assets. They'll earn 6% per year on those accounts, and they'll need to increase their $70,000 per year of income by 3% to keep up with inflation. They're going to live to 86 and 89 respectively. Now, if this couple does in fact file for Social Security right away, you'll notice the blue lines here are covering about half of their retirement income need in those early years. The other half is being funded by withdrawals out of their 401k plans. You see the orange lines there. The red line sloping up across the screen is their total income need, increasing with inflation. The amount of the orange line above the red line is the amount that they're paying in taxes. If you're noticing that that orange line above the red seems to be increasing at a pretty rapid rate, kind of like exponentially, you're noticing correctly. And that is because this couple is having to pull more and more over time to keep up with inflation out of their investment accounts. And as they do that, they're doubling up on the taxes with Social Security. And so, yes, the taxes are not increasing linearly, they're increasing exponentially. Now, eventually, you'll notice here that the orange lines stop. The orange lines have stopped, not because something wonderful has happened, they don't pay taxes anymore. It stopped because they ran out of money. Okay. Now, the only difference between this screen that we're looking at right now and the next one I'm going to show you is a change in the Social Security filing decision. This couple and many folks can benefit greatly from advanced tax planning, but we're not implementing anything like that in this discussion because I want you to see just how important Social Security and taxes, the decision making process, those two things go hand in hand. And it's really important that you're able to grab a hold of that. So, the next slide is simply a change in the Social Security filing decision. If this couple will fund their retirement income from their 401k accounts in the early years, then what you'll notice is as they get further down the line into their years once they filed Social Security, those benefits kick on and they're covering more than 75% of their retirement income need. And so it drastically reduces what they need to pull from their investment accounts. In addition, I don't know if you can see it, there's a little orange above the red line, but not much. It is not uncommon when we do pre planning for folks to get them into a position where they pay very little and sometimes $0 in taxes once they trigger those Social Security benefits. They file the Social Security benefits, they reduce how much they take out of their 401k, and lo and behold, their money lasts their entire life. Fantastic. They also do start paying some higher taxes, but hey, they have money and the taxes are there. Now, here's a tax comparison. If they file Social Security early, the blue lines, or excuse me, the blue lines above the orange lines are the optimized plan. So they optimize and they pay more taxes early. But look at all the orange lines above the blue lines. That's all the excess taxes that are being paid simply for filing Social Security early. Now, eventually the orange lines go away, but they're broke, so it's not a good deal. Okay. Now, to summarize what happened here, if they use an optimized Social Security strategy, they're actually going to get more money out of Social Security. Their portfolio is going to last 14 more years, and they're going to pay $35,000 less in taxes, even though they weren't paying any taxes for 14 years when they filed early. So it's a win across the board for them to optimize their Social Security claiming strategy. A few things about your statement. There are no cost of living adjustments applied to that statement. The statement assumes that you work all the way until 62, retire, file immediately, or all the way till 66 or your full retirement age, retire, file immediately, or you work all the way until 70, retire, file immediately. What's not on your statement is, well, what if I work till 65, go on Medicare, but maybe I want to delay my benefits till 70? That's not on your statement. It's your work history only, no spousal coordination, no widow benefits, no ex-spousal benefits, and then certainly and obviously no advice. So look, after hearing our presentation today, you may feel that you could use a more individualized assessment of your benefits. If you feel that way, we are making available to you at no cost a free Social Security analysis. This analysis, if I could say so, will be the best analysis that you've ever received. Now, if you've never received one, obviously that's going to be the case. But look, maybe a little hubris on my part, but this analysis is really going to dive deep, especially around taxes. And I am very confident that if you get this analysis from us, you're going to be blown away by it. It's going to be very helpful to you. Now, if you are thinking after hearing the presentation that you'd like to get a specified analysis, let me just tell you a little bit about what's in it. Okay, so personalized strategies specific to you. It'll highlight what's the best strategy for timing. When should you file for the benefits? If you're married, when should your spouse file for benefits? What's a break even analysis? How's the timing look on that? Maybe I get a lot more money over the next 10 years, but what happens after that? What happens when I'm 80? What happens when I'm 90? What happens when one of us passes if I'm married to the widow benefits? All this is a part of the analysis. The other thing that really sets our analysis apart is our retirement income and cash flow analysis, including the emphasis on taxes. So, our tax analysis is something that really dives deep on evaluating what kind of strategies are going to make a big difference. This couple here really benefited greatly by doing Roth conversions. If they do significant Roth conversions, it increases their net worth by $700,000. It reduces the taxes that they pay over their lifetime by about half. And so, a big improvement to their situation to implement some advanced planning. So, we'll evaluate all that with you as a part of your analysis. Now, if you're thinking that the analysis would be helpful to you, you're going to go to the same website that you go to request the workbook. Okay. The workbook may be requested at ssworkbook.com. Okay. That's ssworkbook.com. When you go to that website, you will be able to request your workbook. And if you would like also the analysis, you are very welcome to request the analysis. Again, it's at no cost to you, and you can do that right on this website. Now, why do we provide a free analysis? Um, Contrary to popular belief, it's not necessarily because I love working for free. It is because our experience is that those who get this analysis from us are very likely to see the value of their work that we're doing with them and for them. And they are also very likely to consider using our services with other retirement planning or investing needs that they may have. Now, I think you'll be very impressed by this analysis, and it may open up that opportunity where I may earn the right or the privilege, maybe I should say the honor of serving you with other planning needs that you may have. Now, if we get to that point and we go beyond the free stuff, you will be notified. No surprise bills in the mail, nothing like that. The most common way that our clients hire us are through investment advisory fees. Our average advisory fee at our firm is 0.86%. So if you're curious where fees land, on average, about 0.86%, but it is a tiered fee schedule. We also have some other fee schedules that people can go on. It just kind of depends on your individual needs and situation. Okay, so that's the typical way that folks pay us when they get past the free stuff. So if you're just curious about that, I do like to be upfront about it. Again, our firm is Entrust Investment Services, and Financial Resource Academy is a service of Entrust Investment Services. If you found today's presentation to be helpful, please do like, subscribe, follow us on Facebook, give us a subscribe on YouTube, all of that stuff. We really appreciate that. Also, leave us a review on our Facebook page, if you would. Let others know that you found this workshop to be very helpful. That really helps us a lot, and we appreciate that. So with that, I'll start taking questions. Simply pop your questions into the chat. So on YouTube or Facebook, you can type your question in and I will answer it. You can also go to ssworkbook.com at any time, and that will get you going for the analysis and requesting our Social Security workbook. Okay. Okay, so let me go here. Feel free as you have questions. Go ahead and punch those into the chat again on Facebook or YouTube. Either one is just fine, and we'll be happy to answer those questions. If you're on ssworkbook.com and you're requesting the workbook and the analysis, happy for you to do that, and uh, we'll uh, we'll get that going for you. When you request the analysis, it will take you to a scheduling page. You'll be able to schedule right on my calendar, and we'll get some time set up where we can go through your analysis. The first visit, by the way, it's going to be on Zoom or a video conference setting, just like this. And so I'll be on camera. You can be on camera if you like. Happy for you to do that. But we'll sit down together, go through the information that I need to get the analysis. We'll have another visit after that where I'll actually deliver that analysis to you. You'll get a copy of it. It will be yours. Okay. I do want to leave it open for questions if anyone has any they'd like to chime in. Okay. Sharon asks, just curious if there are any statistics about people not getting to 70 when they go, when they think, hey, I'll delay till 70, but they don't make it. So I don't know of any statistics. That's interesting, Sharon. I think I'll look into that because I am curious myself. But I don't know how many people die before the age of 70, let's say from 62 to 70. I'm not sure what the percentages are, but it's an interesting question. I agree. Michelle asks, so what happens if you take money out of a 403b when not at full retirement age? So long as you're over the age of 59 and a half, you will owe um, uh, ordinary income taxes on that, Michelle. But you won't, it doesn't affect your Social Security benefits. Okay. So the earnings test is specifically earned income. Withdrawals from 403b would not affect that. Okay. So good question. A common question, Michelle. I hope that answered it for you. Oh, you're welcome, Sharon. Okay, other questions? Welcome, Michelle. CJ agrees that the questions are good. All right, excellent, CJ. I am located in Michigan, but we are able to provide this analysis to you regardless of your location. You are very welcome to um, work with us regardless of where you are. Okay, so we can do the analysis if you're anywhere. I've done analyses for people in Hawaii, Alaska, Maine, Florida, all the corners of the country, and everywhere in between. So yeah. Hope that answered your question, CJ. Okay, other questions, thoughts? Yeah, thank you, CJ. Appreciate the question. Okay, I do see that many of you are requesting the workbook. We've had a few people request the analysis also. So Do want to give you a minute to ask questions if that's important to you. Happy to leave things open. Yeah, you'll get a digital copy, Sharon, and I believe because we have some other things we want to mail to you. If you're getting the analysis, we mail you a physical copy also, but a digital copy for sure, Sharon. Yeah, I see lots of people are requesting the analysis and all that. So I won't rush away so that you can ask your questions. Oh, you're welcome, CJ. Thank you. Very kind, very courteous. Thank you very much. Okay, maybe we'll do last call. Last call for questions. Again, we really do appreciate anyone following us on Facebook, subscribing to our YouTube channel. If you are inclined to leave us a review, let others know that you found this workshop to be helpful. Do that on our Facebook page, especially. We really appreciate that. But with that, we'll go ahead and end for tonight. Thank you all very much for your attendance, for your good questions, and I look forward to meeting with many of you very soon. Thanks, everyone.